Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. Happy holidays. And today we're going to kick it off with some economic updates, review how the portfolio has performed, and really discuss what we see happening between now and the end of the year and early into next year. So Cam, let's talk about some economic numbers.
All right. The economic numbers that have been on kind of everybody's mind have been really two strong numbers. Two numbers that we weren't really expecting. This would be third quarter GDP and then the November jobs report. Let's go to third quarter GDP. First, if you'll remember, the advanced estimate for third quarter is published by the Bureau of Economic Analysis, came in at an annualized increase in the third quarter of 2.6%. On November 30th, the Bureau of Economic Analysis came out with their second look at third quarter GDP. That number came in at 2.9%. So we had an increase in third quarter annualized GDP from 2.6% to 2.9%. Not a huge difference, but almost 3% GDP increase on a $30 trillion economy is quite a big number. Mm-hmm. So GDP looks like it's going to come in much stronger. Now the jobs report for November, that was published December 2nd by the Bureau of Labor Statistics. That came in at 263,000 jobs created in the month of November. That was much higher than the consensus estimate of 200,000. The unemployment rate stayed even at 3.7% unemployment rate. So, you know, we're really in this, it's not that Goldilocks economy, but we're in this situation where we thought first and second quarter we saw negative GDP, thought the economy was starting to slow down. Obviously, interest rates have gone up significantly. Inflation is still very high. You know, these should all be drags in the economy, but it's just not showing up in the numbers right now. So
the unemployment numbers, that was kind of a mixed signals. It seems like more people are coming back into the workforce.
Yep.
Even though you're hearing about layoffs are starting to happen. Just this morning, heard an anecdotal data that CEOs are actually having an easier time finding people now. Mm-hmm. So we definitely are having some labor shift.
Well, and frankly, most of the layoffs have been predominantly in the tech sector.
Correct.
And those were jobs that had become so bloated because of the demand.
A lot of overhiring.
A lot of overhiring. Sure. And if we see that at Twitter, if Elon Musk is able to lay off 75% of his workforce and
nothing changes.
Nothing changes. Yeah, you had some bloating. So, yeah, I mean, definitely. And you know, anecdotally, what we're also hearing about is that the money that has come into the economy from the pandemic, people are finally, you know, that's kind of run its course. People have to get back.
Exactly.
People have to get back and get back into the workforce. So, what's interesting about this is we've got the FOMC, the Federal Open Market Committee meeting on December 13th and 14th. And it was almost a slam dunk, I think, for a while that people said it's going to be a 50 basis point increase in December. That, you know, should give the Fed enough ammunition where they can now, you know, take a step back, pause, see how the economy reacts. But with these strong numbers, you know, that consensus estimate of 50 basis points, I'm hearing people now talking about maybe another 75 basis point increase, which would be 5 full 75 basis point increases this year.
I think he's going to stay at 50.
I do too.
But we have to expect another one in January, and you know the ultimate, they call it terminal rate, which is as high as they're going to go. You know, earlier, you know, a couple months back or last several months, we were thinking that was going to be in the 4.5% range. That number's starting to get pushed up a little bit, more maybe 5, 5.5, 6.
I've heard some rumblings about 6, which.
Yeah, and part of it's, like you mentioned, all the stimulus money flowing through. That's kind of, you know, that's definitely dragging out and causing distortions in the numbers. But also, I'll circle back and really, we're probably going to have some kind of recession, but this is not a economy slows down, we go back to where we're at. I really call it more of a transition. And once again, there's going to be different winners and losers. People that were, you know, the jobs lost in tech, I don't think those come back. I think a lot of those workers end up in different industries. So maybe not just tech focused, but working for a corporation in their tech, you know, in their tech area. So it's, you know, we're definitely shifting sands underneath us, and there's definitely going to be winners and losers.
Yep. And I mean, to underscore that, you know, kind of the robust resiliency of the U.S. economy, the Atlanta Fed's GDP forecast model for the fourth quarter of 2022, this is their estimate as of December 1st. That estimate is 2.8%. So 2.8% annualized growth in the fourth quarter. This actually number is down from 4.3% November 23rd.
That was the first estimate?
That was the first estimate, was 4.3. So
pretty aggressive.
Very aggressive. But if you look, I mean, losses in the first and second quarter, 2.9 increase in the third quarter, 2.8 in the fourth quarter. We're still going to be looking at annualized GDP of about 1% increase.
Right.
Which is below kind of the targeted 2%. But, just given all of the noise in the economy, still the U.S., remains very resilient, and I think it goes to play into what you've said. A lot of people are talking about, yes, there will be a recession in 2023, but I think right now everybody's expecting it to be pretty darn mild, or a transition, as you called it.
Yeah, and so you're hearing more mild, but maybe more drawn out, so to speak. My expectations, I think we're going to see corporate earnings show some weakness. By the time we get first, second quarter announcements, that's going to, probably show some corporate earnings weakness. But then again, there's still going to be some winners and losers. I think the typical winners may not be there, and the typical losers may be the winners.
Yep.
So you've definitely seen a rotation. We've seen that already in the stock market. But if we start to have, weakness in corporate earnings, that typically means you're probably looking at some sort of more of a traditional recession, getting into, middle of the year type scenario. And, I'm going to dovetail right into the markets, really, that would really signal more of, okay, we probably have our leg of weakness ahead of us at some point. But very well, with the Fed being that far into their interest rate hiking cycle, we've already seen, going into recession, you see the corporate earnings weakness. The next big leg down, if that's kind of how it plays off, could be kind of the final drop in the market at that point in time. Hard to say, but things, obviously the ball could bounce in a couple good ways, and we never see that. So that's kind of why we have to stay invested. Is the key is knowing where we're at.
Well,
so,
it would be nice too to get back to more of a traditional market where we're not seeing these wild swings.
Right. Well, that's characteristic of a bull market.
Yeah,
or a
but
bear market, a bear market.
yes. S&P down 20% 1 year, S&P up 20% 1 year.
Right.
Let's get back to kind of good monetary policy, good fiscal policy, and good kind of consistent corporate earnings by solid, defensible companies that make money and have a reason for being.
That's as simple as it
boring.
gets. Absolutely.
Boring, but
work.
But is good.
Absolutely. So in November, the Dow Jones up 4.82%, S&P up 5.32%, so two really strong months in a row for both indexes. NASDAQ up 4.55%, so kind of lagged the three of them. Small caps kind of had a mediocre month, up 2.15%, but small caps they were really strong in October. On the international front, the MSCI EAFE, which is developed world, big month there, up 11.1%. Part of that, the dollar weakened a little bit, so that gives a little bit extra juice to international stock pricing. Emerging markets also a big month, up 14.6%. So year to date, through the end of the month, Dow Jones was down 5.7% year to date through the end of the month. S&P down 14.6%. NASDAQ still in bear market territory, down 26.7%. The international markets through the EAFE down 16.8%. Emerging markets down 21.2%. And then the Russell 2000, which is small cap stocks, down 16% year to date. So kind of the lineup the last couple of months has been consistent. The winners and who's leading the pack.
And it would be much worse if we jump to today. We've had some ugly,
we would have gave up a little
initial days in December.
The last couple of days. So dividend yield from a portfolio standpoint, November, great month, up 6%. Year to date down 3.9%. So that portfolio is hanging in there really well, doing well. November gainers, EPS up 14%. LyondellBasell, chemical company, up 12.6%. Cisco Systems, 9.4% to the upside. Eaton Corporation up 9.5%. November laggards, there were no negative positions, so we're not going to go any further than that. Year to date, Merck is our big winner in dividend yield, up 47%. Con Ed up 19%. Caterpillar still doing strong, up 17%. Coca-Cola up 10.6%. So once again, your boring type companies.
Traditional dividend producing stocks.
Laggards, Intel down 39%. Blackstone, which did so well for us for a number of years, down 25.9%. A lot of that's because of their real estate exposure, and we'll see a little further down the list. Real estate's been, definitely felt pain in November. Verizon down 20.9. In our growth with income portfolio, November up 6.2, good month there. Year to date down 5.6. Big gainer in November, big gainers, Microchip Technologies up 29%, NVIDIA up 25%, Nike up 18.3, Starbucks 18.7, so some good numbers there. Disney in November down 8%, still lagging. Our real estate ETF that we hold down 2.9, Apple also down 3.3. Year to date, our big gainers, Exxon up 89, Nucor up 33. Commodities still up commodities are still up 11.8%, and Pepsi up 9%. Year-to-date laggers, NVIDIA still down 42%, even after a great month. But once again, that's another stock that we made a ton of money on.
For us.
We took a lot off the table in January, so that we won't really not full exposure there. Nike's still been feeling some pain, down 33% year-to-date. Disney, same thing, down 36% year-to-date. And then our home builder, Lennar, down 23%, which, from a home builder standpoint, I think we've seen the worst out of Lennar, and they're actually set up very well for, moving forward. And I did a little extra research in here, and historically, with what we've seen from a sentiment standpoint, everything, it really signals that we're probably, I think that's going to be a good holding for us moving forward. Price potential. Great month, up 7.9%. Year to date, we're still down 9. Big gainers, Facebook, Meta up 26.8. So it was worth holding on to that. At least we're getting some back there. Analog devices up 20.5. Intercontinental Exchange up 13, and S&P Group up 10. Really one laggard, Humana down 1.5 last month. Year to date, though, Humana's up 19%, so they gave up a little bit last month. Asbury Auto up 8.6. Boston Scientific up 6.6 for the year. Big laggers year to date still. Meta's down 65. CarMax down 46. Comcast down 25. Our last portfolio, small caps, like I said, kind of everything else did great. Small caps just kind of hung around. For November, we're up 2.75%. Year-to-date, 9.2. Year-to-date number is pretty good. Big gainers in the month. Titan Machinery up 28. Universal Logistics up 18.7. Performed Line Products up 18.9, so not too bad there. Laggards, once again, typical with this portfolio. Ascent Industries down 27. Consolidated Water down 20. Lantheus Holdings down 16. So good ones, bad ones, made a little bit of money in there. Year-to-date gainers, like I say, Lantheus down 16 for the month, but still up 115 for the year. Not too shabby there. Clearfield up 56. And Cyber Optics, which we just got into probably in less than a month ago, or not more than a month ago, up about 31%. Laggards, Stewart Information down 43, Evertech down 32, and Bank Financial down 3.9. So, it was a good month. I think we're hanging in there. I think we're well positioned. Could we rally into the end of the year? Maybe the rally all came and went in November, October. But typically, going into the end of the year, you get some tailwinds on the stock side of the equation. So I don't expect a whole lot happening between now and the end of the year. But I think we have probably some rough seas ahead of us, at least in the first half next year. Mm-hmm. On the bond side of the equation, we really don't talk about bonds very often. And the reality there is, for the 10-year Treasury, if you bought the 10-year Treasury, government Treasury bond at the beginning of the year to date, you'd be down 14.2%. So that's definitely been a drag, especially on conservative portfolios. Now, in general, for us, we pretty much stayed away from the longer-term bonds. I looked at, the biggest position that we've used for bonds. We've used one or two different positions, but the reality, year to date, those positions are up, on any given day between 0 and 2%, maybe negative 1%. So that's kind of helped us, is that we've stayed away from the longer term bonds. And then like the U.S., the aggregate bond index, once again, that we're not invested in, just kind of put things in perspective. Year to date down 11.4%. So, That's caused a lot of pain for investors. I don't think the longer-term trend in those long-term bonds, I think most of that pain has been felt. I don't see that much downside left in longer-term bonds. I'm not really ready to go there at this point, though.
No, certainly not. I think one thing people have to remember is, everybody thinks of bonds as a safe, liquid investment, and it can be, but you have to be prepared to hold the bond through maturity. Correct. If you buy it at par. Because obviously, when you have increasing interest rates, bond prices go down because bonds at lower interest rates are less attractive than bonds that you can replace them today and get better interest. So it's just something to be cognizant of. That's why we stayed very short, and really we're thinking about liquidity needs, how short do we need to be, and as prices do get into that, if yields get into that 5-6% range, we would certainly lock in.
Absolutely. I mean, I'd love to see them get there. The 10-year has kind of been stuck below 4, and so you have the 10-year at 4 and the 2-year at 3.6 and the 2-year over 4%. That's called an inversion.
Yep.
So either short-term rates have to come down or long-term rates have to go up. And with the path that the Fed's going on, continuing to raise rates and seeing maybe a higher terminal rate, that's on the short end. I just don't see them reducing rates right away, which tells me there may be some more room on the longer term bonds. A lot of bond managers will say no way, and they can create reasons why not. I'm not going to play that game, so we'll stay away from it and see what happens. If they go up, great, we can lock in. If not, we're not going to get burned if they come back down.
Yep. And in addition, we are processing RMDs, have been processing RMDs for retirement accounts. So you should see that money come into your checking account or your bank account. However, you've designated it. If for some reason you don't notice your R&D, please let us know. We've also been doing year-end kind of tax planning.
Yep. A little bit of loss. Yeah, a little bit of loss offsetting. And that's kind of been a mixed bag.
Yep.
So it's more on an individualized basis.
Yep. So with that, we hope you have a Merry Christmas, a Happy Hanukkah, and a great New Year. We'll be back in January to talk to you. Have a great holiday. All the best from the Ellsworth Advisors family to you and your family.
Happy holidays. Thank you.